Something is happening this weekend that most gold owners have absolutely no idea about. And if you hold any gold, whether that's physical bullion sitting in your safe, a gold ETF in your brokerage account, shares in mining companies, or a gold IRA, what you do between now and Monday morning could make a serious difference in how you come out on the other side of what's brewing in these markets. I'm not going to waste your time with vague warnings or general investment platitudes. What I want to do today is walk you through exactly what's unfolding right now in the gold market, why the next 72 hours matter more than most people realize, and the specific steps that experienced gold investors take when they see a setup like this one developing. Because make no mistake, this is a setup, the kind that comes around only a handful of times in a generation. And most retail investors, most casual gold owners, are going to completely miss it. Let's start with where gold is right now. We're sitting well above $4,400 per ounce. Think about that for a moment. A year ago, gold was trading more than $1,000 lower than where it is today. That is not a slow, grinding bull market. That is a repricing, a fundamental reassessment of what gold is worth in a world where the rules of money are being rewritten in real time. And silver, which tends to lag gold during the early innings of a major move and then explode during the later innings, is trading above $70 an ounce, a level that would have seemed almost fantastical just a few years ago. But here's what nobody is talking about on financial Twitter, or in the mainstream press, or in the weekly update emails you get from your brokerage. The gold move we've seen so far, it's the calm before the real storm. What's setting up this weekend is the kind of catalytic confluence of factors that historically, and I mean historically, going back decades, has triggered the next major leg up. And if you're not positioned correctly before Monday's open, you could be leaving enormous value on the table. Or worse, watching gains you've already made evaporate because you didn't understand what type of gold exposure you actually hold. So let's get into it. The first thing you need to understand is that not all gold is created equal. This sounds obvious when you say it out loud, but the consequences of not understanding this distinction are enormous. And right now, in this particular market environment, they matter more than they ever have before. There are essentially three types of gold that most people own: physical gold, coins, bars, bullion you can hold in your hands; paper gold, ETFs, futures contracts, gold certificates, anything where you have a claim on gold but don't actually hold it. And then there's mining equity, the shares of companies that pull gold out of the ground. Each of these behaves completely differently during a crisis, and what's unfolding this weekend is, at its core, a crisis of confidence in paper. Here's the thing about paper gold that the industry doesn't advertise. When you buy a gold ETF, even the big, well-known ones, you are not buying gold. You are buying a financial instrument that is supposed to track the price of gold. And under normal market conditions, that distinction doesn't matter much. The ETF price moves with spot, you make money when gold goes up, you lose money when it goes down. Fine. But we are not in normal market conditions. We haven't been for a while. And what happens to paper gold when the system comes under stress is a very different story. Think back to what happened in early 2020. When the pandemic hit and markets went into freefall, gold's spot price actually dropped initially. Not because gold was less valuable, but because institutions were selling liquid assets, including paper gold, to raise cash. Meanwhile, physical gold premiums, the price you actually pay to hold a real coin or bar in your hand, skyrocketed. The paper price and the physical price diverged in ways that hadn't been seen in years. People who owned physical didn't panic. People who owned paper watched their gold drop alongside everything else, at least temporarily. The lesson was brutal and clear. In a crisis, paper gold behaves like paper. Physical gold behaves like gold. Now fast forward to today. What's setting up this weekend is a convergence of geopolitical, monetary, and market structure factors that haven't aligned quite like this before. And I want to walk you through each layer, because understanding the why is what separates investors who make smart decisions under pressure from those who get shaken out at exactly the wrong moment. Let's start with what's happening at the institutional level, because this is where the real money moves happen before they show up in the price. Central banks around the world have been accumulating gold at a pace that is simply staggering. We're talking about net purchases that have broken records multiple years in a row. China, Russia, India, Turkey, Poland, even smaller central banks in Southeast Asia and the Middle East. And here's the thing. These institutions are not buying gold because they think it might go up a little. Central banks don't speculate. They are buying gold because they are restructuring their reserve assets away from dollar-denominated holdings. They are quietly, methodically, over years and years, doing something that looks a lot like an exit from the post-Bretton Woods monetary system. If third sounds dramatic, consider this. After World War II, the United States established itself as the world's reserve currency through the Bretton Woods Agreement. Every major currency on Earth was pegged to the dollar. The dollar was backed by gold at a fixed rate. It was, in theory, a stable and trustworthy system. Then, in the summer of 1971, President Nixon did something extraordinary. He closed the gold window, unilaterally ended the convertibility of the dollar to gold. No more fixed rate, no more peg, just floating fiat currencies, backed by nothing but trust in government. What happened next was one of the greatest transfers of wealth in modern history. Gold, which had been officially suppressed at $35 an ounce, was suddenly free to find its true market value. Within a decade, gold went from $35 to over $800 an ounce. People who held physical gold through that decade didn't just preserve their wealth, they multiplied it. People who trusted in government bonds, in savings accounts, in the official financial system, they watched inflation destroy them, quietly, slowly, and thoroughly. We are living through the early stages of a second inflection point. Not a repeat, history rarely repeats exactly, but a rhyme. The de-dollarization that central banks are engineering in slow motion is the monetary equivalent of what happened in 1971, except this time it's happening in reverse. Instead of breaking the dollar's link to gold, the world's reserve managers are reconnecting their portfolios to gold. And they're doing it because they've watched what the United States has done with dollar dominance, sanctioning nations, weaponizing the SWIFT system, freezing foreign reserves, and they've concluded that dollar dependency is a strategic vulnerability. The BRICS bloc, which now represents a significant and growing share of global economic output, has been openly discussing settlement mechanisms that bypass the dollar. Trade deals are being struck in local currencies. Bilateral agreements between major economies are routing around Western financial infrastructure. This is not conspiracy theory territory. This is documented, on-the-record policy. And every time another percentage point of global trade shifts away from dollar settlement, the demand for the alternative, which is gold, goes up. Now here's where it gets specific to this weekend, because all of that macro backdrop exists whether it's Monday or Saturday. What makes the next 72 hours particularly critical is what's happening in the market structure of gold trading itself. The COMEX, the commodities exchange in New York, where most paper gold contracts are traded, has been experiencing something that traders call a delivery premium. This is the signal that physical gold is getting harder to source. When you trade a futures contract on COMEX, you're technically trading a contract that could be settled by delivering physical gold. Most contracts are never actually settled in physical. They're rolled over or closed out in cash. But lately, the premium to stand for physical delivery has been rising. More buyers are demanding actual gold, not a cash settlement. And that matters because the entire paper gold market is built on the assumption that most people will never actually ask for the metal. When people do start asking for the metal, when the ratio of paper claims to physical gold gets stress tested, the consequences can be dramatic. We saw it in microcosm during certain episodes in the early part of this decade. We saw it historically during the gold pool collapse of the 1960s, when Western central banks tried to hold gold at an artificial price and ultimately failed when demand for physical overwhelmed the system. The paper price eventually converges to physical reality. Always. The only question is when and how violently. The setup going into this weekend is that we have elevated geopolitical tension, a Federal Reserve that's caught between stubbornly persistent inflation and a fragile economy, and a physical gold market that is under the kind of structural stress that historically precedes a sudden repricing event. Weekends matter in this context because markets are closed. Geopolitical events don't take weekends off. And on Monday morning, when the first prices tick in Asia, which is where global gold trading starts each day, whatever happened over Saturday and Sunday will be baked into the first trade. So what do you actually do? The first thing is to audit what you have. Right now, today, before Monday. Pull up your accounts. Identify every gold position you hold. And for each one, ask yourself one critical question. If this position went to zero tomorrow, could I get my gold? If the answer is no, if your gold exposure is entirely in paper form, that is a risk worth understanding clearly. not necessarily a reason to panic, but a reason to think seriously about your exposure. The second thing is to understand the difference between allocated and unallocated gold. If you hold gold through a custodian or a storage program, there are two types of arrangements. Allocated gold means specific bars or coins are assigned to you with serial numbers. They are yours. They don't appear on anyone else's balance sheet. Unallocated gold means you have a claim on a pool of gold, but that pool may be partially or substantially loaned out, hedged, or encumbered. During a normal market, this distinction is academic. During a stress event, it is everything. The third thing, and this is genuinely important for people who have been sitting on gains in their gold positions, is to think about rebalancing. When an asset class has run as hard as gold has, it's worth asking whether your current allocation still reflects your actual risk tolerance and retirement goals. Not because gold is going down, I'm not saying that, but because discipline in managing a winning position is what separates long-term wealth builders from people who turn a great investment into a story they tell about how they almost made a lot of money. And speaking of building long-term wealth, if you're watching this and you haven't yet checked out the free guide I've put together that's linked in the description below, I'd encourage you to do that. It covers the saving strategies and wealth protection approaches that thousands of American retirees are using right now to secure their financial futures. It takes about 5 minutes to read, and it's completely free. Link is in the description. Now, back to the market setup, because there's another layer to this that I haven't addressed yet, and it might be the most important one for people who hold gold specifically in a retirement account. The paper versus physical distinction matters enormously in a retirement context. Most people who have gold exposure in a 401k or traditional IRA have it through mutual funds, ETFs, or mining company shares. They don't hold physical gold. And that means they have the price exposure, but not the actual protective properties of the metal itself. In a banking crisis, in a currency crisis, in the kind of systemic stress event that doesn't just affect one sector but spreads across the financial system, paper claims on gold inside a paper financial system don't provide the protection that physical gold provides. A gold IRA is different. A properly structured gold IRA holds actual IRS-approved physical gold coins and bars in an approved depository on your behalf. It's inside a tax-advantaged retirement account wrapper, so you get the tax benefits. But the underlying asset is real metal, not a fund share, not a derivative, not a promise. And that distinction in the environment we're moving into matters more than it has in many years. I want to be honest with you about something. The reason I bring this up, the reason I think it's worth mentioning, is not because I'm trying to sell you something in the middle of a market update. It's because I've watched what happens to people's retirement security during financial disruptions. And the ones who have some portion of their wealth in physical precious metals inside their retirement accounts consistently sleep better and fare better during the chaos. Not always, not perfectly, but consistently better than those who are entirely in paper. If that resonates with you, if you're sitting on a traditional IRA, a 401k, or another retirement account, and you've been wondering whether you should be diversifying some of that into physical gold, there are ways to do that without triggering taxes or early withdrawal penalties. It's a rollover process, and it's more straightforward than most people assume. The reason most people never do it isn't because it's complicated. It's because nobody tells them it's an option. The implications of what's happening in the monetary system right now extend far beyond any weekend. We are living through the slow-motion rewriting of the global financial architecture. The institutions that write the rules, central banks, sovereign wealth funds, multilateral development banks, are all quietly moving toward gold. Not in a way that makes headlines every day, but consistently, persistently, at a scale that has no historical precedent in the modern era. Think about what it means when the institutions that have the most information, the best analytical teams, and the longest time horizons are all making the same bet. Central banks don't buy gold because they think it might outperform the S&P 500 next quarter. They buy gold because they believe the current monetary system is moving toward a fundamental restructuring, and they want to be on the right side of that transition before it becomes obvious to everyone else. The 1970s taught a generation of investors what happens when monetary certainty breaks down. The collapse of the Bretton Woods system unleashed inflation that ground down middle-class wealth through the entire decade. People who had saved diligently in dollar-denominated assets, savings accounts, government bonds, pension promises, watched the purchasing power of their savings halved and then halved again. Meanwhile, those who held gold multiplied their wealth many times over. Not because they were clever or lucky, but because they held a form of money that cannot be printed, cannot be inflated away, and cannot be defaulted on by a government that decides it has borrowed too much. We are entering a period where those lessons are becoming relevant again. Inflation has been more persistent than central banks predicted, more damaging to savings than the official numbers fully capture. The Federal Reserve is caught in a bind that it has no good way out of. Raise rates high enough to kill inflation and you crash a debt-laden economy, or cut rates and you risk reigniting the inflationary spiral. Either path has serious consequences, and gold has historically been one of the few assets that performs well on both sides of that kind of policy dilemma. The geopolitical dimension adds another layer. Trade wars, sanctions pressure, regional conflicts, the fracturing of multilateral institutions, each of these creates additional demand for gold, as nations and investors alike seek assets that exist outside of any particular country's financial system. Gold has no counterparty risk. It doesn't depend on any government honoring a commitment. It doesn't rely on a central bank maintaining credibility. It just is what it is, a finite resource that human civilization has used as a store of value for thousands of years. The silver angle is worth addressing too, because silver sits in a fascinating position right now. At over $70 an ounce, silver has made an extraordinary move. But the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is still historically elevated. What that tells you is that silver, which has both monetary and industrial uses, has more room to run on a relative basis than gold alone. The industrial demand story for silver is explosive. Solar panels, electric vehicles, semiconductors, medical devices, and that demand is structural, not cyclical. It's not going away. Which means silver bulls have both the monetary argument and the industrial demand argument working in their favor simultaneously. For gold holders specifically, understanding this dynamic matters because in a major precious metals move, silver tends to amplify whatever gold does, both on the way up and on the way down. If gold continues its upward trajectory, history suggests silver could outperform significantly. If there's a correction, silver tends to pull back harder. So the risk profile is different. But the fundamental drivers are aligned. Which brings me back to the core question of this video. What should you actually do before Monday morning? Here's the honest, direct answer. If you hold paper gold and you've made substantial gains, review your exposure honestly. Ask whether your current position reflects your actual goals, or whether it reflects a position size that made sense at a different price level. If you hold physical gold, make sure you understand the security and insurance situation around your holdings. If you have gold in a retirement account, understand what you actually own. Is it physical, paper, mining shares? Does it match your intentions? And if you've been meaning to look into diversifying your retirement account into physical precious metals but haven't pulled the trigger, the current environment is as compelling an argument as any to at least get informed. Not to panic buy, not to make impulsive decisions based on weekend anxiety, but to understand your options with clear eyes before the kind of move that makes that decision obvious in hindsight. The investors who look back on this period and feel good about what they did will not be the ones who reacted emotionally to every swing. They'll be the ones who understood the larger picture, the monetary restructuring, the institutional accumulation, the physical versus paper distinction, and made deliberate, informed decisions about how to protect and grow their wealth in an environment where the old rules are breaking down. The ones who look back with regret will be those who saw the signs, meant to act, and kept saying, "I'll get to it next week." There's a reason the most successful wealth preservation strategies are built incrementally, steadily, and early, not in a panic when the headlines are screaming and the premium on physical gold is through the roof and the waiting list at the dealers is 6 weeks long. Monday morning is coming. Markets don't care about your weekend plans. What matters is whether your portfolio is positioned to protect what you've built, regardless of which way the next catalyst breaks. And if you've watched all the way to the end of this video, I want to give you something genuinely useful. The free guide in the description covers the core strategies, but I've also set aside time for a limited number of exclusive one-on-one educational consultations. Completely no obligation, no sales pressure, just a focused conversation with a specialist who can walk through your specific situation, your retirement accounts, and what options are actually available to you. This is available specifically for American retirees who have $100,000 or more in any retirement account. Just mention that you watched to the end of this video when you reach out through the description link, and we'll get you scheduled. No obligation, no pressure, just real information from someone whose entire focus is helping people in your position understand their options before they need them. Take care of yourself, stay informed, and I'll see you in the next one.